Thank you for that. I have about 1 million questions for you, and they're all drinking out of a fire hose of news, so we're going to get to a whole bunch of things. But I do have one major follow-up just on the conversation that you proposed around AI, which is we've heard from people like Sam Altman, who runs OpenAI, that the employment picture, you touched on employment, but only this much. He talks about the need potentially for UBI, Universal Basic Income. That employment could be so devastated, maybe by 10, 20, 30, 40%, literally pulled out of the market, even if it's pulled out of the market for some temporary period of time. How do you contemplate the true employment implications of all of this?
You know, Andrew, it's a great question. I mean, part of the reason that I used the scenario-based approach, and it was just 2 scenarios among many possible scenarios.
And which one are you betting on?
Is that we don't know. We don't know exactly, how this is all going to turn out. We have seen lots of episodes throughout history of technological innovation and people being concerned that the new technology was going to make everything that currently existed obsolete. And what we've seen most of the time in history is that the labor market adjusts, but it is a very painful adjustment. So the kinds of things that we need to be focused on are things like universal basic income, income supports, earned income tax credit, retraining measures, all those things. But it is likely that this technology is going to be very disruptive, and we don't know precisely in what ways. I think it's the right kind of question that we should be addressing now, because as I said, I mean, my view is that AI is kind of overhyped right now. In the short term, I think people are expecting more from it last year, this year, next year. But I think probably underappreciated in the long term in terms of the kinds of changes that it could cause in our society. So the right time to ask is now.
You said there were 1 million headlines, and I want to talk about them. One of those headlines was you.
Yeah.
So I want to go there, if we could, which is that on January 6th, you said that you were going to resign as the vice chair of supervision from the Fed. Take us inside the room in terms of your decision to do this. Obviously, there was a lot of speculation. I have to imagine, I know, it was part of your thought process that President Trump was going to push you, and you jumped before he pushed you. But walk us through the whole process.
Yeah, Andrew, it was a very, very difficult decision for me to make. And I'd say in some ways a very painful decision. But what I did is I just looked at the cold hard facts. And my judgment was that if I stayed in the role, that the fight over this role would become a major distraction for the Federal Reserve. It'd be a distraction for the Fed, it'd be a distraction for me, it'd be a distraction for the team of people that I fed. And that distraction would have prevented us from doing our job serving the country. And to me, it just wasn't worth it. So I decided to step down from the vice chair role, continue on as governor, where I'll remain. My term goes to 2032, which is a long time. And I figured I could best serve the public by staying on that role and not become a distraction from our work.
But all of this is in the context of the independence of the Federal Reserve. And I want to read you something. This is Natasha Sarin. This is an op-ed in the Washington Post. I'm sure you read it. This is in the context of your decision to resign. If the Federal Reserve is politicized and weakened, the winners will be large financial institutions, the losers will be all of us. Unfortunately, that's already happening before President-elect Donald Trump is even sworn in. Choosing not to fight the battle is the same thing as losing it. The Federal Reserve is signaling to banks that the sheriff has left town, somewhat literally in Barr's case.
Hey, look, I said this was a difficult decision for me to make and personally painful to make, but I'm the only one who can make it. And unless you've sat in the chair and you've looked at the trade-offs, it's very easy to be a commentator on the sidelines and take shots. I'm used to people taking shots at me. It doesn't bother me. I think I made the right thing, the right judgment for the Fed, the right judgment for our economy, the right judgment overall for serving the public. Other people can have different views. I understand that. If it were an easy call, it would be an easy call to make. It's not an easy
But
call.
because, I mean, you made the
But I
decision
think that
because you
that
felt that
protected us.
the independence of the Fed would otherwise come under even more intense pressure.
Yeah, I mean, my judgment was that fighting the fight about this position would be a huge distraction to the Fed. It would put the Fed in the crosshairs. And that's not a place that I think was good for the Fed to be. And so I made the judgment to step down. Again, I recognize that other people could make other judgments, but I think that's the right judgment to have made, and I feel comfortable with it.
Let me ask you a separate question, which is somewhat related, which is, given your role supervising banks, one of the other institutions that is being dismantled, quite literally in front of us, is the CFPB. What do you make of that? Are you concerned about that?
Let me just, take a step back. It is very easy in the current environment we're in to be focused on the kind of day-to-day issues that arise. And it's totally appropriate to focus on those things. They're meaningful, they're real things. But if you take a step back and look at the longer sweep of history, we have very, very strong institutions in the United States. They have survived lots of different stresses to them over the sweep of our history. We have an enormously successful, vibrant, energized economy that survives the ebbs and flows of different administrations. So we're an incredibly strong country, big picture sense, and I'm not worried in that sense.
Okay, and we're going to talk about the economy and where you think we are.
Yeah.
Let me ask you then another headline, which maybe you will disregard, but nonetheless, I think a lot of people are concerned or at least questioning it. I see Jack Lew is in our audience. He signed a letter along with a whole number of other former Treasury secretaries, very concerned of the payment system in America. Our current Treasury Secretary, Scott Bessent, has said that the DOGE team is not, in fact, inside of the Federal Reserve, but is in fact inside the Treasury, but that payments can't really be made from the Treasury. Speak to this. What do you make of what is happening here?
Well, let me say, first of all, I appreciated very much Secretary Lew's letter and the letter, signed by other former Treasury secretaries on this issue. It's really important to have a payment system that the American people can rely on. When Congress passes laws, agencies make payments according to those laws. The payments should flow through to the people they're supposed to. If I'm due a tax refund, I expect that my tax refund will be paid to me according to the law. So we need to make sure we have a system with integrity, and that's absolutely essential.
So then the question is, does it have that integrity? Given that Scott Bessent has said that the payments are made by the Federal Reserve and actually not by Treasury, is he accurate about that?
We receive the Federal Reserve banks act as agents for the Treasury Department in making payments for the United States government. So any file that we receive from the Treasury Department, we process and we pay according to the law. So that's always been the case, and the Federal Reserve is doing that now. I can't speak to anything that the United States government decides to do, but once the Treasury sends us a file, we make the payments on that according to the law.
Maybe slightly differently. If you were put in charge of trying to find efficiencies in the government, and it hasn't been done this way before, but would you go to the Treasury and try to get inside the systems? Because, like a great bank robber, they always say you got to go where the money is, you got to go to the bank. Is this where you go to try to understand where all the money is moving? Is this the right way to approach it, or do you think it's not?
I can't really speak to the motivations of the folks doing it. Let me just say that the Federal Reserve's role in this is a very defined role. We receive files from the Treasury Department. We pay through the payment system on those files. It's the way we've always done it. People can have confidence that we're doing it that way today.
But we don't know if the payments are being changed on the other end.
I don't have anything at all to say about that. I don't know anything about it.
Let me ask you a little bit about where we are in this economy right now. We just had CPI numbers that came out last week, hotter than expected, about 4.5%. That is still far from the 2% goal that the Fed would like to see. where do you think we really are?
So, I think we've made a lot of progress on inflation. We've got, first of all, a strong economy. We had really strong growth last year, over 2%, nearly 2.5% growth last year. We've got an unemployment rate that is low at 4%. It seems stable and has been stable since last summer. That's very encouraging. And if you look at inflation, we think of it in PCE terms. It's gone from over 7% headline, again to 2.6%. It's gone from 5.8% to 2.8% in thereabouts in core terms. So we've made enormous progress on inflation. There's still a lot more we need to do, but the overall path of inflation has been on I would say, a bumpy but steady and I think sustained path towards 2%. The bump up that we saw in January was something that we anticipated based on the seasonal pattern that we've seen in the past. I expect it will moderate again in February and March. So that's all, I think, positive. And then, we need to look at what the policy environment is and how the policy environment may change the trajectory of all that.
So let me ask you about that, which is the other sort of main headline that we talk about almost every day endlessly is tariffs. And how do you think the Fed should be thinking about that? I will tell you that Christopher Waller just said that his baseline view, this is actually new just today, is that any imposition of tariffs will only modestly increase prices and in a non-persistent manner. Is that a widely held view?
Well, I don't want to speak for Governor Waller or for any of my colleagues. I'll just tell you what I think.
Okay.
I think it's too early to know the answer. So there's a lot of uncertainty about the policy path for the government. There's uncertainty about tariffs, who they're going to apply to, how long they're going to apply, for what kind of products, how they affect final goods and intermediate goods, the extent to which they may be permanent or maybe temporary. All that's uncertain. And then there's uncertainty on the fiscal policy path more broadly in terms of tax cuts. There's uncertainty about the shape and scope of immigration policy. So, at least for me, I'm in a wait and see position. I'd like to understand better what the policy is, and then decide what the implications for the economy might be, and then decide what the implications for monetary policy might be. So I'm not in a rush to answer that
How do you
question.
make of the argument that by default that means you're going to be late?
I don't think so. I mean, look, we're all of us in our individual way make our own judgments about this, but we go meeting by meeting and we're looking at the data as it evolves. Right now, if you look at the economy is strong. It's been a strong economy for quite some time. The unemployment rate was ticking up last year, and that caused me some concern. But it then moderated and has stayed pretty steady. And so the unemployment rate feels stable. The labor situation feels stable. The labor market has cooled a great deal over the last 2.5 years. So we're in a situation where we can actually, I think, take the time we need. Now, if it turns out that inflation drops faster than we expected, or if it turns out the labor market weakens more than expected, then we can act. I think we're in a position.
As it relates to immigration and this crackdown, how quickly do you think we're going to see that, and how quickly do you think we're going to see this in the numbers? We're not at all.
So, the immigration policy itself is up to the administration. I don't have, comment on what they decide to do, and we take that in our forecast. And to me, it's just too early to know. It's too early to know what the policy will be. It's too early to know what the effects of the policy will be on the economy, and therefore what the implications, if any, for monetary policy are. As a general matter, if you reduce the labor force, you reduce potential output and you reduce output. So we'll look to see whether that is of a scale to see that in the economy.
Curious, maybe this goes back to a supervision question, but there's been a lot of headlines recently about this idea of debanking. In fact, Jay Powell was asked about it just last week. And whether, in fact, you believe that banks in the United States have effectively debanked certain customers and clients because of their political views. In fact, President Trump very directly said to Brian Moynihan, who runs Bank of America, that he believed the Bank of America and that Jamie Dimon at JP Morgan was engaged in debanking.
I haven't seen I haven't seen any evidence of that kind of activity. Now, the thing that people raise more directly is a bank engaged in activities that are higher risk and therefore reducing their client exposure because of concerns about money laundering or terrorist financing, for example. And that of course happens if you're a bank and you're worried that you have a client that may be engaged in unlawful activity.
Right.
You're going to reduce your exposure to that kind of risk. That's sort of appropriate risk management. But I haven't seen this, so just my own view, I haven't seen the kind of thing that
Jamie Dimon apparently made references in Washington and suggested that actually the regulations that are put on the banks in some ways have required the banks to not do business with certain folks, and that because of the kinds of industries that you may be referring to, but also I include crypto in that, that in fact they have had to debank certain clients, not because they say they want to, but because they say that some of, but this may relate to some of the supervisory issues that have come out of Washington, and obviously you've been in that role.
Andrew, we try very much at the Fed to kind of play straight up on the middle on these issues. So we have institutions, banks of all sizes, supervised by the Fed, that are engaged in crypto-related activities, either themselves directly or supporting clients who do crypto work. Our expectation is they do that in a safe and sound way and in compliance with the consumer laws and in compliance with the laws against money laundering and terrorist financing. And if they do that, that's fine with us. We have a novel supervision program designed to supervise institutions in this space to make sure we have the expertise we need to do that right. And we have institutions doing it. And then we have other institutions that did it wrong and got themselves into trouble either because of AML, BPSA problems or because they were unable to meet their liquidity needs of their clients and they went out of business. So to me at least, it's just straight up the middle risk management in banking. If you do it right, you can do it. And if you don't do it right, then you shouldn't be doing it.
I do want to open questions in one moment, but just to bring this all back to AI, I'm very curious if you use AI inside the Federal Reserve.
We do. We're very, very cautious, as you'd expect, at the Fed in using AI. We have a very strong system of internal governance over it. But we experiment with using it in very controlled ways. So, for example, we have a lot of coders at the Fed because we run the payment system. We have thousands of engineers at the Federal Reserve. And one of the things, as you know, coders have to do is test their code. And the unit testing you do for code testing is pretty boring work and it takes a long time. So we've experimented with using generative AI along with a human coder to see if we could speed up that process. And yes, we could. So those are the kinds of efficiency improvements that I think you'll see more broadly in society. So yes, we use it, but we are super careful about it.
Do you think long-term, you have several hundred economists who work for the Fed?
Mm-hmm.
Do you think long-term you will need all of those economists?
I think we might need more of them. The economy is super complicated. We use them, we use models today. A lot of what the Federal Reserve economists do is understand models. And we take those models as an input into a forecast. But the forecast involves a lot of human judgment. We were just talking before about the uncertainty about policy. We have to make a decision how much of that uncertainty you build into the forecast or not. Human judgment is an important part of that. And models are really good at data-rich environments and less good at places where there's less historical experience. And so you have to also account for that. I think economists and engineers and coders and writers and philosophers and everybody else will still have playing.
I hope you're right. Let's open it up.
And certainly journalists.
Let's open it up for questions. We'll go to the front and we'll make our way back.
Thank you very much. Rebecca Patterson, I'm a senior fellow here at CFR. There's so many questions I'd like to ask, but I'd like to stay in the supervisory part of your world. President Trump is encouraging development of stable coins to have a digital dollar that could circulate globally, provide a new source or greater source of demand for US Treasuries at a time when our supply is increasing. What type of, do you think we will have the regulatory framework we need around stablecoins that will make them truly stable? Tether, for example, right now about 15% of its reserves are not treasury or cash-like securities. And do you think it's necessary for us to prevent further research on a central bank digital currency at the same time? That's what President Trump has said in his executive order, that that research is basically done.
So on the first, we don't currently have any stablecoin regulatory arrangement at all. And it would be good for us to have a stablecoin arrangement in the United States. The Federal Reserve has been working at the request of Congress for many years now to try and develop a consensus framework in the United States that we could support. We'll continue to work on that. There was a lot of effort made on a bipartisan basis over the last 3 years or more to develop that kind of consensus approach for stablecoin legislation. I was very encouraged by that process of bipartisanship, and I hope that it continues and that we can continue to offer our expertise for that process. You know, stablecoins, dollar-based stablecoins, really, borrow the trust of the Federal Reserve, and so it's absolutely essential for us that there be meaningful regulation and supervision of stablecoin issuers. And I would very strongly support that. Whether stablecoins play this broader role or not in the economy, I think is a separate question. If we have material amounts of stablecoin issuance in the country, we want to make sure that they're done in a safe and sound way. Central bank digital currency conversation is a different conversation. We've said at the Fed very clearly that whether we issue a retail CBDC that's a matter for the president, for the Congress. That's not something the Fed could just go do, or would ever want to go do. That's for the elected branches to decide what to do.
Question here, and then we'll get there.
Great, thank you, Andrew. Joseph Gaspar, Roebuck of Canada. Thank you again for all of your service. How do you think about broader solidarity or regulatory harmony when it comes to AI governance? If you think of a case study for GDPR, where the US had to import this European regulation and potentially it kind of curtailed or slowed down various industries in the US. Thank you.
It's very early in the process to think about AI regulation. I think it's the right time to have that conversation. And I do think the discussions we have across borders make a lot of sense. They add to our ability to make good judgments about it. But I'm not sure that it's a space where we need to reach 100% agreement on an approach across jurisdictions. It's, I think, new enough that a little bit of given the joints, a little bit of experimentation actually might be a positive development. But I feel that way only in the short term. That is, in the short term, I think we have the space to figure this out and get this right and be flexible in the joints, so that over the longer term, we have a framework that in place that's protective of the right set of values, and we're not talking in 10 or 20 years about the kind of downside scenarios I discussed before.
Yeah. No.
Hi, I'm a term member here at CFR, and I was illegally fired from the CFPB last week. I led the CFPB's work monitoring consumer financial markets' use of AI. And my question is, what does the financial marketplace look like without a functioning CFPB?
Look, I think it's really important that we have significant oversight of the financial sector for both safety and soundness and for consumer protection. The CFPB, as you know, and many members of the audience know, has jurisdiction both for the largest institutions in the country for consumer compliance and for the whole non-bank financial sector, which is not, neither of those areas are covered by the Federal Reserve or other prudential regulators. So I think a CFPB on the block is an important part of the overall picture. We need to make sure we have a marketplace that is appropriately covered for all products and services that affect consumers.
Just back here.
Vice Chair Barr, thank you for your comments. Andrew Watros of Morgan Stanley. I have a question about the GSEs, and I'm curious how you see the regulatory environment for the GSEs evolving in a world where they're privatized. And I'm especially interested in the risk weights that could be applied to GSE securities. Thank you.
So, the oversight of the GSEs has been a hot political topic for many administrations at this point. And I won't prognosticate on whether that will be the same or change under the new administration. It's sort of far outside my lane. We kind of take the structure of the mortgage market as a given, as an input into how we think about the economy and how we think about capital rules and the like. And I just don't want to speculate about the direction.
Ma'am?
Hello, thank you. I'm a Caballero, I'm the chair member here. Vice Chair, you mentioned that you're not worried about the Fed's independence and that you're confident in the strength of the U.S. institutions. Where do you get that certainty from?
I'm not sure I've said any of the exact words that you just said, so let me just say what I think. I think overall that the strength in U.S. institutions, that the U.S. institutions are strong, and if you look over the long sweep of history, they've stood the test of time. I think that's true of the Federal Reserve too. We've been an agency, independent agency for more than 100 years, and that has served the American people well. And so I'm really talking about it in a large historical sense. I was not given a "don't worry, be happy" speech.
Can you recall a time in history that where you think that the Fed's independence was under more question?
Well, I think if you look again at the long sweep of history, the creation of the first Bank of the United States was a deeply politically fraught moment in the United States history, and it was contended with for its whole sweep and allowed to end. And then we had the second Bank of the United States that was also a very contentious political moment in the United States, and it was allowed to end. And then we had the creation of the Federal Reserve, which was, as you know, a compromise among competing political forces in our country, between people who wanted a powerful central bank in Washington, people who wanted it distributed around the country, between people who wanted a public institution, people who wanted a private institution, and we're that compromise. So it's not unusual for the country to be fighting about the role of the central bank. I think if you have a long enough sweep of history, it helps set the conversation a little bit in perspective.
We're going to set questions. We'll go to you.
Thank you. Compliments on how Virginia Gale. One thing I'd like to ask you about that you touched on briefly in terms of what you're looking at in terms of the future of the structure of the economy, and that's the debt situation. And without going into all the details, we're going to have clearly a very heated debate on the debt issue coming up very shortly. I wonder if you could give us your thoughts on what the dangers are of the trajectory that we now see and is sort of validated by a lot of economists. And it's hard to know when the problem will occur, but we know that when these things happen, at some point, a problem does occur. I wonder if you could elaborate on your thoughts on when we approach the danger zone and what the dangers you see are of the sort of broken system that we seem to have had over the last couple of decades.
Yes, so let me do this in as careful a way as I can. So I don't want to comment at all on the current fiscal conversation. That is, what the appropriate mix of spending and revenue is, and what choices Congress should make. That's for the President and the Congress. But taking a longer term perspective, the trajectory of debt to GDP keeps going up and up. It varies a little bit on whose model you use, but the direction is not in doubt. And most people would say that that's not a sustainable path for the debt of the US or any economy. And what they mean by that is a bunch of different things. One is that the portion of the expenditures that we all engage in on an annual basis become increasingly apportioned to paying off that debt. The interest expense becomes a larger and larger portion of the budget, which crowds out other things we might want to do as a society. It shifts the burden from our generation to our children's generation, our grandchildren's generation. It probably increases the term premium that you pay, that the federal government pays to issue debt, which means it's even more expensive over time to issue debt. And other countries have seen at very, very high levels that, not uniform rule, but at very high levels it becomes, the financial system becomes more fragile and more susceptible to shock. So it is, in a long range sense, something to worry a lot about. And of course, the longer you watch it, the harder it becomes to adjust.
Sure.
I wanted to follow up.
Which mic?
My name is Andrew Dunlop, CEO of Bleisher. I wanted to follow up on Andrew's question about tariffs. As you know, they start with pretty weak currencies relative to the dollar around the world. And if you can share with us your thoughts about the pluses and minuses of resetting the terms of trade bilaterally through tariffs, as is currently being done, as opposed to multilaterally through a evaluation of certain overseas currencies, Plaza Accord type of thing, and whether or not you think ultimately, if the goal is either to change the terms of trade or revalue the dollar, Trump has not said which one it is, nor has Scott yet, if we're necessarily going to get to a Plaza Type 2 Accord, which, Andrew's question, would certainly be at least theoretically inflationary based on history.
So it's a really terrific question, but also one I'm going to be really careful not to answer. So like my answer on fiscal policy, let me not get into the short-term tariff debate. At the Fed, we take the government's decisions about that as given. That is, the president and the executive branch and Congress get to decide what our tariff policy is, and we'll take those into account in our forecasts of what's happening in the economy, and then decide how to react in terms of monetary policy. Tariffs, just as a general matter, will raise the price level, and the question is, do they raise the price level on a short-term basis? Do inflation expectations remain well anchored or not? How much persistence is there in price increases because of the effects on intermediate goods that might play out over time? Those are the kinds of questions that we ask ourselves in thinking about the forecast. But we don't weigh into the question whether we should have tariffs or shouldn't, or what they should be.
Can I actually just follow with this?
Yeah.
Because this is something actually we do know.
Yeah.
So one of the things that is happening right now, even though we don't know what the tariffs will be permanently or even on a short-term basis, we hear at least anecdotally from folks like the CEO of Ford, who says that right now, that company is going back and forth between the border of the US and Mexico, bringing products and supplies to the United States as quickly as humanly possible at a cost to them today, because they don't know the uncertainty on the other side of what's going to happen. That has not emerged in the numbers yet. But when you think about that, how do you assess that situation, and given all the conversations I'm sure you're having with business leaders and others today, putting aside what the tariffs are in the future, just the prospect of the tariffs are doing what?
So the short answer is it's consistent with what you said. It's not showing up in the macro data. So we're not seeing the kinds of shifts that would suggest widespread activity of the kind you described, although in discussions with business leaders, it's clear that it is going on in some instances. And if you think about an automobile supply chain, the parts that are used in an automobile don't just come into a country or out of a country. They, in our case, they go in and out of Canada, Mexico, and the United States as the car is being built multiple times. So manufacturers are thinking about how to organize their supply chains given that. It's very hard to change your supply chain in a short period of time. So there will be price changes within those products. And then we'll be looking at how those flow through both, at the border in terms of import prices, but also in their intermediate goods and then into final consumer demand. And it's too early to know the answer to the question whether it will be macroeconomically significant or not. I don't know. But directionally, tariffs have the effect of increasing prices, reducing productivity, reducing growth, and you need to look at how those things offset each other to understand whether or not there should be a monetary policy reaction function to that basket of changes.
We are almost out of time, and I know there's been a question in the corner in the back for a long time. Thank you for your patience.
Oh, good afternoon. Thank you. I'm Ken Kraetzer with CaMMVetsMedia. I just want to go back to Mr. Barr's opening about AI. I worked in banks for a long time in my career. Is AI increase the risk of cyber threats to banks? And if you're advising banks, would you say that AI is a tool to help prevent cyber attacks or to detect them like the military does? Thank you.
It's a great question. I think in the sense the answer to your question is both. That is, AI is increasing the ability of fraudsters and cyber attackers to infiltrate the financial system. And it is increasing the ability of banks to protect against infiltration by those attackers. And there's going to be kind of an arms race about use of AI for good and for ill in that space. And so I do think that banks are and should be investing in additional skills for their workers, additional R&D for the technology, as they are, to make sure that they stay current, or they can get ahead of that arms race. But it's happening, and it will happen.
And before we let you go, Jim, do you know who is going to take your supervisory role that President Trump is going to appoint?
I do not know.
Do you know if he's going to appoint anybody?
I do not know.
Have you had any conversations with anybody about this?
No. It's anybody's guess.
Thank you very, very much.
Thank you.